Morning children. Today we will see the chapter 7 of plus 2 accountancy course. In this we are going to deal about company accounts. So company accounts where a company is started after due legal procedures and wanted to raise money from the public for running the business. In this chapter, the important factor of production, that is capital, how a public company raises, that we are going to see. The theoretical aspect is dealt in commerce subject in your plus 1 commerce. Now we are going to see the practical aspect of it, how a public company raises capital and what is capital and what are the various types of capital and how it is raised procedure. Also we are going to see the practically how a company makes journal entries in its books, and in the event of occurrence that a shareholder fails to pay some money, how it is recorded, how the shares are forfeited for non-payment of dues, and how it is reissued to next person, and also how the shares are issued to persons those who contributed capital in the form of assets, that is consideration other than cash. These are the things we are going to see, though the chapter is little elaborate in this book, but it is very easy to understand. So you have to take it, and in your BCom course this one chapter is going to be one paper for you. This is a introduction. What you are getting this year will be a good experience for your BCom second year course. There we are going to read in detail. So this will be the forerunner for it. Now let us see. What is the meaning of company? We know what is company, joint stock company. And here we are going to deal about what is company definition as per law. Company is a voluntary association of persons which has separate legal entity. It has a perpetual succession. Perpetual succession means it has long life. The life of the company does not depend upon the life of the members. Perpetual succession. It doesn't die. The people may die, but the company doesn't die. And the liability of the member is limited to the amount outstanding on its shares, unpaid on its shares. So separate legal, these all things are already dealt in plus 1. Separate legal entity, company's life is separate from the member's life, and it is a voluntary association. There is no compulsion or natural cause which will associate you with the company. It's a voluntary association. You come with your own willingness. So according to Lord Justice Lindley, a company is an association of many persons who contribute money or money's worth, that is nothing but assets, money or money's worth, to a common stock. That is, common stock means here capital, and employ it in some trade. They put it into business, and who share the profit and losses arising from them. Like partnership, we contribute capital. There are limited number of persons. Here there will be many number of persons, that's all. The profit is being shared among them. The common stock so contributed is denoted in money and is the capital of the company. That's what the people contribute, in the form of money, in the form of assets. The person who contributed in it or form it or to whom it belongs to are the members, or you can say shareholders. This proportion of capital to which each member is entitled is share. So that much shares, if I hold 20% share, that means I will get 20% of the profit. What are the features of company? How a company? This are all just refurbishing about the ideas what you gained last year. Voluntary association, from the meaning, it's a voluntary association of persons no law can compel a person to form a company. There is no compulsion. You are voluntarily contributing your money to the capital of the company. Separate legal entity. It's an artificial person. Natural person, men, animals, they are natural. But company is an artificial person created by law. That is company law. It has separate legal entity which is separate and distinct from its members. Common seal, we know common seal means a natural person may sign a document. He will have a signature, distinct signature, but a company, since it is a person, it cannot sign. So the people working in it in a position, they will be signing it and they will fix the seal of that company. Common seal, a company may have common seal which can be affixed on its documents. Perpetual succession, it continues forever, it has a long life. Its continuity is not affected by the changes in the life of the members or composition. Members may come and go, but the company goes on forever. It can be wound up only by law. Law only can close a company. Since it is created by law, only law can end up the business. Limited liability. We must understand the liability of the members are limited to the extent of the amount outstanding on the shares, or you can say which is not yet paid, that much. So though in our previous learnings we must have found out sole trader, joint into family and the partnership, where the liability of the member is unlimited. So the member has to contribute for the business losses even from the private assets if the business assets are not sufficient. So whereas in company, the member, though he may have a lot of assets, he need not to contribute. How much he will contribute? He will contribute to the extent of the amount outstanding, or you can say not yet paid, amount not yet paid on those shares which are held by him. If I paid full, there is no liability. Transferability of shares, important aspect. In case of sole trader and partnership and joint into family, you cannot transfer the share. You cannot transfer. You have to close the business, then start a new business. But here, the company, there is a dissolution of firm. But here, the shares can be easily transferred to next person. That makes it attractive. It is easily transferable. You can go to share market, sell your shares, next person will become shareholder. These are the characteristics or features of a company. What are the various kinds of shares or types of shares issued by a company? There are preference shares and equity shares. There are two types of shares. Earlier there were one more share, but from previous Act amendment, it is limited to only two types of shares. One is preference share, another one is equity share, or you can call it normal share. What are preference shares? Preferences. Shares means capital of the company is divided into small units of fixed amount. That capital is divided into small parts. Each part is called share. Totally collectively it is called as capital. Individual small part is called share. One is preference share, another is equity share. Preference shares are those shares which will have two preferential rights. If a share has some additional rights, that is nothing but payment of dividend at the fixed rate. That is, dividend is nothing but a share of profit. The preference shareholders will get the profit at a fixed rate from the profit before the equity shareholders. Preference, they get the dividend at the fixed rate before the equity shares. Before somebody takes, first it is given to preference shareholders at a fixed rate. Second, they get repayment of capital in case of winding up. When the company is wound up or closed, the assets are realized and the liabilities are paid, the balance amount is distributed to the members according to their holdings. In such situation, these preference shareholders will get their capital first before the equity shareholders. Equity shareholders are those shares which are not preference shares. If it is not preference share, then it is equity share. That's all. Or you can say they don't enjoy any preferential rights. How the share capital is divided? Till now we might have seen capital means only one capital, which is shown on the balance sheet. On the liability side, what you do in the final accounts of what you learned in +1, capital plus add the net profit minus the drawings will be the resultant capital in the balance sheet, final closing capital. Here in the company's balance sheet, we have to reflect capital under different headings. Let us learn what are the difference. Authorized capital, or you can say this is the maximum capital a company can raise from the public for meeting its objectives. So objectives are shown in the memorandum, what the company is going to do the business. For achieving that objective, what is the maximum capital required is given here, or you can say it is also called as registered capital, or you can say nominal capital. So you can alternative names, it is registered, the capital with which the company is registered. Issued capital, it's a bigger amount, so of which we may take a small part of the capital issued to the public. So it represents a part of authorized capital which is offered for subscription to the public, which is sold now, which is being sold now. Next is subscribed capital. It is a part of issued capital which has been applied for and also allotted by the company. That means the people came forward to put their money in the issued subscription, that is issued capital. If it is fully taken up, it is called a fully subscribed. If it is partially, then it is called partial subscription. Called up capital. The called up capital represents a part of subscribed capital which has been called up by the company for payment. So the company may take all the money together in one installment, or it can take in different installments. So collecting all the capital at a time will be a burdensome to the subscriber or a shareholder. So the company may allow itself, if its article permits, they may divide the amount and they will collect in installments. So each installment is called up capital. Paid up capital, what is been paid by the shareholder. Shareholder, if he pays full, then it is fully paid up. If it is partial, then it is called partially paid up. So it is a part of called up capital which has been actually paid by the shareholders. Sometimes some shareholders may not get the letter, he must have not paid the called up value. Such way, how much is received by the company, that is paid by the shareholder, it is called paid up capital. This first 5 will appear in the balance sheet, all the 5, and from the 5th only it is to be added for the liabilities, and the 4 will be shown as informative, or you can say these are all the data must be given on the balance sheet, so that a person who reads the financial position of the company will come to know what is the maximum capital, how much has been issued for the public, how much has been subscribed, how much is called up. Now paid up capital will be the actual capital which will be added with the other liabilities. And the last item is reserve capital. This is a reserve, means we know amount set aside to meet some emergency. So the company preserves, or you can say reserves, some part of its capital will be called up from the shareholders at the time of winding up. So at the time of winding up, we may find difficult to raise some money for meeting expenses. Such time the company will call the shareholders. It is a part of subscribed capital left with the shareholder, and it will be called up only at the time of winding up. This will not be shown in balance sheet, that's to be understood. It will not be, it is a reserve capital which will not be shown, which will not be reflected in the balance sheet. It's an important 2-mark question, you have to mark it. How normal shares are issued to the public. Preference shares normally issued to the promoters, and equity shares are normally issued to general public. The procedure what you learn here, the same is for issue of preference shares also. So how the equity shares are issued? Public issue, which is open to everybody. Anybody in the world can apply and collect the shares, or you can say you can subscribe into the share capital, that is issued public issue. And private placement, where the public are not allowed, but some financial institutions, they subscribe into the share capital of the company and they give the capital in bulk, and the company allots the shares in bulk to the particular financial institution or bank. That is private placement. Private placement means any offer of equity shares or invitation to subscribe equity shares to a select group of persons by a company other than public offer through the issue of private placement letter, offer letter, which is satisfying the conditions specified in section 42 of Company Act 2013. So it is given to private person. It is not that private person, is financial institutions and banks. Rights issue. Rights issue, if you understand, a company already existing company, and if it want to raise additionally, it want to improve its objectives, and instead of going to the public, at the time of going to the public, before offering to public, it will ask its existing shareholders for subscription of additional capital. If they are willing, they can buy the shares of that company. If they don't, or they reject the offer, then the company will go to the general public. Or you can say issue of equity shares to the existing shareholders of the company through a letter of offer is known as rights issue. So the existing shareholders will be given first preference and they will be allowed to subscribe. If the company is good, then existing shareholders themselves will purchase all the shares issue. Such rights issue, such are called rights issue. And the last is bonus issue. What do you mean by bonus? Bonus means gain without any work. Additionally, you gain. Without paying any money, you get shares. The company, what it does is, whatever the profit the company earns, a part of it, it keeps aside as a reserve. Over a period, the reserve gets accumulated, and now if the company wants to give it back to the shareholders, it is called a bonus issue. Without taking money from the shareholder, a company converts its reserve into capital is called a bonus issue. Issue of equity shares to the existing shareholders of the company at fixed cost out of accumulated profit is known as bonus issue. Okay. With that, various kinds how a capital is raised by the company: public offer, private placement, rights issue and bonus issue. How the issue is recorded in the company's books is shown here. On receipt of the company, normally let us say issues a shares of rupees 100. 100 rupees share is issued to the public, and if a person applies for it, how he has to pay this 100 rupees? It sometimes they divide it into some installments. The first installment is called application money, where the prospective shareholder will receive the application and he will read the prospectus, he will fill the application. According to his savings, he will apply for number of shares, and he will fill the application where he has to sign, he has to attach the check, or you can say money to it, and he has to apply to the company. Company after collecting all the applications, scrutiny it, and it will put the money in a separate bank account. And receiving that application money, first installment, that is bank account to equity share application account. Now the application money is, or you can say first installment is received. This money is now belongs to transferred to capital account, where next entry is made, share application account to equity share capital account. That is amount received through the application will be transferred to capital. These two journal entries for receiving the application money and putting into share capital. If the application is rejected due to any material fault, then this will be returned back to the public. Those who are filled it wrongly, it will be returned. Refunding money, it is a reversal of the first journal entry. The third journal entry is nothing but reversal of the first journal entry. These 3 entries are over when you deal with application account. Next, second installment. So 100 rupees is collected in the form of 20 rupees, 30 rupees, let us say 30 and balance 20. The first amount is called application money, second is called allotment money, third is called call money, and fourth is also called second call. So such way the things can be divided into at the maximum 5 installments. So first application money, then allotment money. What it does, the applications are scrutinized, rejected applications are refunded, the balance approved applications, they will be sent with allotment letter. Allotment letter is nothing but a shareholder must have applied for 100 shares. How much shares are allotted to him is informed through a share certificate issued to the shareholder. He becomes shareholder. Earlier he was a prospective investor. Now after making an allotment, he will become a shareholder, or you can say member of the company, or you can say the owner of the company. So for getting the second installment, the company gives share allotment letter to him. How much shares he has applied, how much he has to now pay the second installment. For making when the letter is made and money is expected from him, equity share allotment account to equity share capital account is made. That is, when you send the letter, and when you receive that money from him, the shareholder, or you can say the public who has given with the allotment letter, he will now pay the second installment. That is bank account to share allotment account. Same way, calls are also informed to the shareholder through a letter, or nowadays through email, and call money is received from them. In the same manner, equity share call account, if it is first call account, to equity share capital account, and when you receive the money, it will be bank account to equity share call account. These entries are repeated for next call also. So this is a main core of the issue of share capital, where the application money, allotment money and call money are put together to form the capital of the company, which will be shown in the balance sheet. Now, it is not when it offers, people may come forward. People read the prospectus issued by the company, and if they get a good return, if they expect a good return, they will come forward. Sometimes the company's prospectus is not detailedly projected. In such cases, people will not voluntarily come forward. So under that case, under subscription. So the company offers shares, but there are few takers in the market. Such condition is called under subscription. All the shares offered by the to the public may not be subscribed in full. When the number of shares subscribed is less than the number of shares offered, it is known as under subscription. Under the circumstances, all those who are duly applied will obtain allotment, provided minimum subscription as mentioned in the prospectus has been subscribed. A company, it has offered for subscription for, let us say, 10 lakh rupees worth of shares. If it receives less than 90%, that is minimum subscription. If it receives only 90%, then only a company can go for next step, that is further allotment. So minimum subscription means it is 90% of the issued capital. That is, offered shares are not taken up by the public. In case if it is a renowned company goes for raising finance, that time it may receive more number of applications. In such case, it is called oversubscription. Receiving more applications for want of shares than what the company has issued, that is called oversubscription. In case of oversubscription, how a company is going to allot the shares? Because it has received, it is having limited number of shares, but if it receives more application, what it can do? It can offer first come first serve basis. Those who come first, they will be allotted. rest all will be rejected. That is the first condition. Some of the applications are accepted in full, others totally rejected. That is first in, first out. Those who come first, those applications received first will be allotted in full. The balance, when it is sold off, then balance will be rejected. Application money is returned to the applicants whose applications are rejected. Instead of returning, what a company can say is, it can allot less number of shares than what they applied for. They must have asked for 100 shares, the company will allot them 70 shares. So it is a proportion of 7:10, that is 10:7. If they apply for 10, they will get 7. Such a way, proportionate allotment. Instead of returning the application, the company can allot less number of shares and adjust the excess money, application money, in the next amount. That is proportionate allotment. Combination of above two also can be applied. That is first come first serve, as well as proportionate allotment also can be made. These are the ways how a over subscription is dealt, for which a number of illustrations are given in your book, how a under subscription is recorded and over subscription is recorded, because the journal entries remain the same. There will be little change in case of over subscription, because excess money is being adjusted. Now, next topic what you are going to cover is calls in advance. We call it, what are the things are called? Call means a company calls the shareholder to pay certain sum of money. Call. What is call means? A company calls the shareholder to pay certain sum of money due on the shares allotted to him. That is called call. If a shareholder pays a uncalled capital money before the company makes the call, then it is called calls in advance. Or you can say the person pays third or fourth installment along with the second installment itself. He pays in advance. Before the company makes the call, he pays entire money due. Such amount is called calls in advance, whether it can be retained or not. He may pay the company, whether a company can retain the amount, excess amount or not, it is authorized through articles. Excess amount paid over the called up value of share is known as calls in advance. Excess money paid on application or allotment or on calls. Excess money can be any time. Such excess amount can be returned or adjusted towards future payments, whatever due in the coming date payments. If the company decides to adjust such amount, future payments, the excess amount may be transferred to a separate account called calls in advance account. Calls in advance does not form a part of company's share capital, so he cannot claim for additional dividend. That is, and in the balance sheet where it is shown on the current liability of the company. And according to section 50 of the Companies Act 2013, they are authorized to receive interest for the period of excess period held by the company at the rate of not exceedingly 12% per annum. So he has got a right to receive interest at the rate of 12%. So if it is excess paid, it is called calls in advance. If it doesn't pay, then it is called as calls in arrears. Calls in arrear. When a shareholder failed to pay the money due on the call, or you can say upon a letter issued by the company, then it is called as calls in arrears. Then how it is recorded? When a shareholders fail to pay the amount due on allotment or calls, the amount remaining unpaid is known as calls in arrears. And according to table F of Companies Act, interest may be charged on the amount outstanding. The balance amount still due from the company, from the shareholder, is charged at the rate of not exceeding to 10% per annum interest. And how it is accounted? By opening a separate account, that is calls in arrear account, or without opening a calls in arrear account. Both the way you can make a recording. And separate illustrations are given in your book to record how the calls and arrears are shown. Illustrations are clearly given, so kindly go through it. Now let us stop till the calls and arrears in this class, and let's have a small revision. First, meaning of company and definition of the company, and features of company, joint stock company, that is, or you can say public limited company. What are the features? Sometimes you may have to, because in the reduced syllabus of this year 2020-21, where things are in the 7th chapter, there is no practical questions given, they told, but writing a journal entry is nothing but a theory question. So kindly go through the chapter in full of chapter 7, so that it will be helpful for you in the coming college days. Features and meaning different types of shares. One is preference share, another is equity share, or you can say ordinary shares. What are the preference shares, preferential rights given to the preference shareholders, and how a capital is divided: authorized capital, issued capital, subscribed capital, called up capital, paid up capital. All the 5 will appear in the balance sheet, and reserve capital is a separate capital, it will not appear in balance sheet. How the shares are issued to the public, various methods: public issue to the public, private placement, and then rights issue to the existing shareholders, bonus issue to the existing shareholders without taking money from them, or you can say converting the reserve into share capital. Then entries to record a money received by the company under journal entry, and if it is excess received or less number of applications received, it is under subscription. When more number of applications received, it is called a oversubscription. How the things are dealt, clearly given with separate instructions. So you can get into the book with the given examples. And calls in advance, when the money received excess of what is asked for, it's called calls in advance. Then how it is dealt, and when it is not received, it is called calls in arrear. Separate illustrations are given, kindly go through it. Now in the next class we will deal with the forfeiture of shares and reissue. Thank you children, have a nice day.